From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 11th. You're listening to the Macrocast with wild sound from the streets of Paris. This is Tony Fratto. It's been a week in the UK and Paris and Brussels, and we'll talk a little bit about that today. John Fagan at Markets Policy Partners is with us, and the great John Dick is back with we got some ESI feelings and sentiment out there. And guys, I'll tell you, just first off the top, here with all that's going on with with Europe right now with Ukraine and Russia, it is on the minds of everyone. There's we'll get into it more, but just a sense of there was like in the United States, of pretty positive sense coming out of Omicron, mask mandates coming down, things opening up again with the spring, and then now this a little hit to growth and to sentiment, and in real ways also, as John, we talked about before on energy here as well. So a lot to get into. We also have we had inflation spiking, or the reports on measurement of inflation spiking this week. That's a concern here as well. And John Dick, people are feeling it, right? I mean, they're no happier than the last time we checked in, are they?
No. I mean, there's no way to candy coat it. Consumer confidence is in the tank. Our last public reading was last Wednesday, and it was a record low for as long as we've been doing the ESI, going on 10 years. And it's lower yet this week, and with no sort of declining end in sight. Maybe we'll hit a bottom and sort of settle there. But yeah, the consumer is not feeling terribly rosy at the moment.
John Fagan, at least one source of of the bad feelings is certainly inflation. The report this week was, I guess, it didn't surprise anyone. Did it surprise in terms of how fast inflation was? But everyone knew no one was looking for a good report, were they?
Exactly, and that's really the key. There wasn't really very much new information in this CPI report. It was an ugly number, and you've got these headline, highest since July 81 or January 82, and the food component and the underlying details look awful. And as bad as it was, it really wasn't any worse than people were expecting. And did it change? So often the dynamic really is inflation expectations, feeding into what people think about what the Fed is going to do. And as bad as this number was from a headline perspective, it also didn't change really, futures markets or any other, analyst perceptions on how the Fed is oriented toward its meeting next week. There's a lot of expectation that worse is still to come here on the inflation numbers, and that the debate about whether, this was, is this a product of over monetary easing by the Fed, or is it supply shock? Obviously, the balance, however you want to slice it, is tilting towards supply shock dynamics here, and the Fed is in a challenging situation, and they look as though they're ready to proceed with rate hikes, but not maybe at the aggressive 50 basis point clip that some had expected, despite how elevated these numbers are.
I'll just add to that, John Fagan, that Tony, you said sort of inflation is one of the things. I think at least in our data, it's almost like the thing. One of the other sort of subplots of last week's ESI is it was really the first time that we've seen that COVID has kind of lost its stranglehold on the American psyche. Basically, for 2 years, the ESI sort of went up and down almost in concert with the rise and fall of COVID concerns and COVID cases. And this is like an absolute stark departure from that, because concern about Omicron is at its, some of its best levels. Only, maybe early June last year when vaccines had all the optimism pre-Delta. So we've kind of moved on. Not only have we moved on beyond it, but certain things that painful irony about COVID sort of subsiding is that people are commuting to work again. So now they're even more concerned about gas prices than they would have been a year ago when they weren't driving to work. And people are scheduling summer vacations where they're going to drive or buy airline tickets, and the prices are going to go up. So it's almost like, the worst possible timing for all of this to happen as people are planning to get back to their sort of pre-COVID lives again.
That's a really great point. It's interesting. I had been saying for, I think, a couple months on the Macrocast, that Americans are too sour about the economy because, they are as down on the economy as, I know we've only been measuring it for, a little over 10 years now, but you look at, some other measures that have gone on longer. And it's like, they are as sour as the economy as they were, during the malaise days of the A's. Now, I still think it's a much stronger economy. We still have low unemployment and still lots of economic activity. But, when you have this, like, with the sort of 1-2 punch now with, no end in sight on energy prices, coming off, which means inflation sticking around longer. And now the Fed and the ECB, frankly, in a really tough place of, having to do something to choke off inflation. They're not going to, I agree with John, they're not going to be as aggressive as we might have expected 2 weeks ago before Ukraine, but they have to do something, right? I mean, so even, if growth is going to slow down because of inflation and because of just the other disruptions, then it becomes an even trickier job for them. And I usually don't envy them. I definitely don't envy them in this present situation that they're in.
Absolutely not. And we saw that earlier this week yesterday with the European Central Bank decision, where it looked as though to analysts that they succumbed to the idea that they've got to do something, but they aren't really sure what to do. And so they kind of shuffled around the deck chairs. They decided to accelerate the withdrawal of asset purchases and move that into a more aggressive mode, talking about both winding up what everybody expected, winding up the pandemic emergency purchases this month, but finishing up their baseline quantitative easing bond purchase program as early as the third quarter. That's faster than everybody expected, but at the same time, delinking that earlier end to quantitative easing from rate hikes, which they pushed out in time. So it was like this muddled situation. It was characterized as a hawkish surprise, but the euro retraced a lot of its earlier in the week gains, and peripheral bonds and sovereign bonds in the eurozone sold off, and equities fell. It wasn't really something that you would want to see as a policymaker necessarily, and it just, as you say, Tony, it just speaks to the conundrum that they are in, and they have to be seen doing something. But stagflation is a very difficult puzzle to address when you have limited tools, and the supply shock is as intense and intensifying as we see it becoming.
Yeah, and I do look. I definitely worry about it for Europe, and it's on everyone's minds here. That if no one. I haven't seen anyone. I haven't spoken to anyone who said that they were predicting a recession. But I actually think it has to be, that's something that has to be on the table. And it's, it's unfortunate, but they were not powering out of Omicron in the same way that the United States was either. I mean, there's just in the United States right now, we're in a situation where we have, busting out of, post Omicron, making it feel like it's almost post COVID altogether, just a lot of economic activity returning. And not the same linkages that countries here have to Russia. Not that they're all that extensive. I mean, I know we're repeating ourselves a little bit on this, but Russia does not have a very well developed economy outside of commodities, and so there aren't a whole lot of things that are particularly disruptive. But a lot of these companies are, it is costly for them to pull out. It's costly for them to deal with people. The energy costs are real. If you think prices are high in the United States or in California, they're a lot higher here, and home heating is an issue also. So it's just it is a lot of stress for consumers here, and so it's a question as to whether they're going to stick it out.
Tony, I don't know enough about. I'm not an expert on anything outside of the U.S. I know you guys are, but and I wonder how uniquely American this circumstance is. But every time I'm on with you guys, we talk about sort of the bifurcation of the country between the haves, have-nots, and that's really been exacerbated during COVID. But a big thing that we're seeing in the data now is the difference in consumer behavior among sort of people who are financially still better off than they were before COVID and those that aren't. I was looking at NPD Group data this morning on the restaurant industry, and they reported restaurant spending in February was down like a point or two, which is more or less break even. But when you went a level below, restaurant spending was actually up by like 10% among people making over $75,000 in household income and down 9% among people making less than $75,000 in income. And you've got this very sort of two disparate groups of people going in different directions based on their financial wherewithal coming out of the pandemic. And I don't know if other countries that you guys are experts in, like, have that same sort of like wage and income disparity that we seem to be having, this rift between, groups here, but it's definitely coloring, like you said, so many things about the economy here are strong, but it's not monolithic by any stretch.
And that's animating some of the policy debate, obviously, in the State of the Union address. President Biden circled back to some of the Build Back Better, although it's moribund, but Build Back Better in pieces. And so the case that the Democrats have made and are making, I think, in more forceful terms now under the circumstances, which are allowing them to make the case a little more forcefully, is that, lower income strata really need some help here, and that targeting some stimulus policies, not blanketed and the massive kind of magnitude that we saw during the height of the COVID crisis, but some targeted relief for the groups that are most impacted by these supply shock prices. We don't see, food. One of the things, and to your question, John, overseas, one of the things we don't see here in the U.S. is the kind of direct food price impact. Food prices are high in the U.S. and higher, and inflation is really meaningful. But it can be in emerging markets. It can be even more acute, obviously, because they have less processed food. The inputs are more directly feed through into that purchasing basket of households, and it also usually at a time like this comes with a dollar rally, and that's beginning. That certainly has begun to pick up steam here over the last couple of weeks. With the dollar jumping against other currencies. At the same time, oil prices and commodity prices are going up, which means if you're in an emerging market and the value of your currency is going down, and this is a very, very challenging situation. So as obviously as tough as we have it in the U.S., there's the case to be made that our economy and asset, dollar values and so forth can diverge from the rest of the world, which is in even a worse spot.
So what you have in Europe is you do have a social safety net, and so you do have it is easier to be on the lower rungs here than it is often in the United States. It's a little bit more developed here, and they tend to avoid high highs and low lows. Their growth doesn't tend to break out like ours does, and it doesn't spike down in the same way and hurt more vulnerable populations. And we end up having the things that they have on automatic pilot are things that we have to pass extended unemployment benefits for example, or food stamps or other kinds of support. They have more of that established. But we should never forget in the United States that we also have enormous ability to support the economy in ways that are really hard to do here. I mean, Europe was able to do pretty. It took a long time for them to be able to get the fiscal response in place, but it was pretty substantial for Europe, and so they have that underlying support there. Everybody here talking about the failure to get Build Back Better. They just passed that $1.5 trillion appropriations bill last time, omnibus bill for the rest of the year, and did some significant increases in spending in a lot of programs, and there's going to continue to be fiscal support even with the, we know the direction on Fed policy is going to continue to be monetary support too. We're still, pretty accommodative monetary policy situation. Money is still really, really cheap to get here. And so I don't worry so much about the U.S. economy. I think we are going to power through it, but I do worry about them here. I think they're going to have this period is going to be a harder time for them. But at least they were slow to get that fiscal support for COVID. They've also been kind of slow to spend it. So there's still a lot to spend. So they still do actually have some fiscal support coming in from COVID.
And in the global growth sphere, one of the other places that is flashing at least amber on the dashboard is China. We've seen Beijing commit themselves to a 5.5% growth target this year. But that looks like something they might have to make up in a statistical kind of way rather than reality. And the credit aggregates, monetary aggregates for February came in. They all looked weak. Basically, the demand for loans and even mortgage loan growth was negative for the first time since the global financial crisis era. Premier Lee came out and said that the leadership is going to have to do more. And this is at a time when they're really struggling with this COVID zero and how that's not particularly compatible with Omicron and the reality. So that's certainly one to watch. And it's also coming at a time when China has tethered themselves to Russia and created some potential additional blowback on the U.S. policy side. We saw the SEC come out yesterday and identify 5 Chinese companies that are on the potential chopping block for delisting if they don't cough up their financial records to U.S. auditors. This is a challenging balancing act for China, and I think that the eyes of the world certainly are looking very cautiously at Beijing's next move.
John, Dick, are people? I don't know if I asked you this. I think I asked you the last time you were on, but now are people paying attention to Ukraine, Russia? I mean, it seems like it from where I'm seeing. And but do you expect that to last if they are?
Yeah, I mean, they are the 95% of the country is following news on it. 93% are characterizing themselves as, quote, concerned. 87% are worried about some direct impact on the U.S., whether it's direct impact on their finances. There's a heightened level of fear of like cyber attacks on the U.S. as this unfolds. I mean, the country is riveted by it. And I don't mean that just as like news consumers, but it's like front of mind for everyone. The sense that this could bleed into a conflict that has, like safety implications on the U.S. Like, yeah, there's no question about it. It is the thing most responsible, maybe even more so than, quote, inflation directly. It is the thing I believe dragging down consumer confidence the most, which is, yes, partly its impact on inflation and gas prices, but also just a general sense of fear. We haven't been in a situation like this for, there are grown adults right now who've never lived in a world where something like this was happening, where it felt so close to home for us. So yeah, I mean, it is the thing. How long will it last? If it's a protracted war, which it looks like it's going to be, it's hard to, I don't know. It's hard to know.
It's a psychological tax. And, being in the Beltway, you always have to correct for where you are. And so it's quite acute here. But the fact that the statistics that you brought to the table, I think, really are those are huge numbers.
And by the way, they're incredibly nonpartisan. I mean, it's like this thing that people have agreed on the most as long as we've studied this, regardless of the size. I mean, we did a survey this week asking whether people believed companies should stop doing business in Russia. And it was almost universal agreement by both sides of the political aisle. I mean, again, for us to see like 80-90% of Americans agreeing on anything is just astonishing. And this is the thing. I do have one question. Maybe you guys know, I something we could figure out, I guess. But like, I hear you saying sort of that the U.S. largely is better off than most or all other countries in terms of being able to weather the implication of this, or even the implications of like inflation and gas prices, like are largely worse everywhere else than they are here. I wonder if the average American knows that, right? We're so kind of like caught up in, oh my God, all these horrible things are happening to Americans. But I doubt most of them realize we're so much better off than the rest of that. These things are happening. Not only are they happening everywhere in the world, but they're happening worse in other parts of the world.
Yeah. I mean, there's this, I think there's it's always hard to have a huge country like America, which is generally inward looking in so many different ways, cast an eye overseas. And that's, I think that's manifests itself in a variety of different perceptions about the country. But, I don't think that there's anybody that could possibly be watching the news that doesn't have, this incredible sympathy for the refugees in Europe, from Ukraine, and the responses, that the generosity of the people in Eastern Europe to be stepping to the plate and helping out. It's a galvanizing. This is not how you would want, U.S. political divides to be bridged. This is not how you would want the West to be and the free world to be re-energized and galvanized. But that's certainly a dynamic that is manifest.
Yeah, I think that's right. I mean, I know it wasn't Putin's objective to bring, Americans together, to bring the transatlantic alliance back together. But that's exactly what he's accomplishing. I don't know, John, if I don't think people, really, realized it. I do think they see these pictures. They didn't react the same way when it was in other parts of the world, but they do seem to be reacting to what they're seeing on the news today, and it's good to see that people are coming together in universal view of that something should be done about it, and that we are on the right side of this. But it's not going to, like as you said, it's not going to go away quickly. I don't see this settled quickly. I think Putin is pretty entrenched. I think his army is on a clumsy, slow, but ultimately effective march, and his economy is in for really dark days ahead. And I mean, like 1991. Pre-1991 style days. I mean, really, really dark days for that economy. Russian people are not going to be doing very well, and we're probably going to see that, some of that as well. So this is not, it's obviously not good. I echo John Fagan on concern for the people of Ukraine and what they're going through, having literally done nothing. They've done nothing except want to be part of, Western economy and the free markets and democratic countries, and we're in a tough place to be able to help them. We're not really all that able to help them, and that's frustrating for everyone too. But it's true. But you have to look at what the sanctions. So the sanctions that the White House has put in, the commentary. I think I totally agree with the commentary that says that these are concerted, determined, aggressive. They're having a big effect on Russian financial markets, financial assets. A big impact on the economy over the in a very short term way too. This is a very, very strong response. And I think, when you look at the kind of things that people talked about when the risks that the White House might be taking with the dollar as a reserve currency, the questions about whether you have, the wisdom of basically essentially kicking Russia off of this and sanctioning and reaching out and touching their FX, their foreign exchange reserves. I think when we think about it, first of all, if you've got a dollar reserve currency world order, any reasonable order has to have some rules. And if you step over the red lines, you're out. And, no one knows exactly where those red lines are, but we know that Russia's way over them. So if you might as well let in North Korea if you're going to let Russia stay. And then, at this point, and then second of all, the slippery slope argument, like, well, if the U.S. is going to be sequestering central bank foreign exchange reserves, then every reserve manager in the world is going to be worried about their dollar reserves. Well, you don't have to worry about them if you don't have a war of aggression on a neighbor that didn't do anything. It's not like we're just flinging these around. It's a pretty significant standard. And if you're not going to commit a historical
geostrategic crime, you don't have to worry so much. So I think that's and the idea that this is going to push Russia and China to set up an alternate, they were doing that anyway, right? So I think that the dollar system is the stewards of the dollar reserve currency system at the Treasury and the White House are doing exactly what they should be doing.
I agree. I'm not worried about the dollar's role as the most important reserve currency in the world. I don't think it's something that China wants and is even capable of doing. But there's a lot of there aren't just opportunities in being a reserve currency. There are a lot of obligations of why someone would want to reserve in your currency. And that requires, open financial systems. And they don't want an open financial system. They're not going to have an open financial system. That's not part of their goal. So, that's not what they're going to do. And Russia is, it's not even worth the conversation, right? I mean, might as well be talking about like the Brazilian real as a reserve currency. There's, to your point, it doesn't take much, right, to be a decent country. Like, right, don't invade your neighbors, and you're probably going to be okay in the global financial system. It's kind of a low bar. So Russia's not clearing it, but it's a low bar. John and John Dick, I'm gonna bid you all au revoir from Gare du Nord in Paris. Sorry I couldn't get to a quiet place for this, but maybe you got the sounds of Paris on the streets a little bit too. I think we had at least one klaxon European style police car go by. I think you guys heard that, hopefully.
It's the sights and sounds. It brings me back.
I'll tell you this. Speaking of United States, I'll fly tomorrow back to the United States. It's always great to go. I love traveling. Great to be back traveling again after a couple of years. And but it's always great to come home. And so I'll see you back in DC. Catch you on the next Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.